Jared, yesterday was it was fun, huh? Pretty good time.
I'm in the middle of a hurricane right now.
I know. I got thunder rolling outside my window. Luckily, I live on the east coast of Florida. I've been lucky in the last, I don't know, I've been down here since 2018, the last 6-ish years that I haven't gotten slammed by one. It seems to always go to the Gulf. Yeah, yesterday reminded me of that Manic Monday song by the Bangles without the catchy melody, especially since so many headlines I was looking at had the phrase Manic Monday in them when I was researching topics for this episode. In the span of 3 weeks, about $6.4 trillion has now been erased from global stock markets. So, Jared, I guess the $6.4 trillion question is, are we having fun yet?
It really comes down to whether you think this is 2007 or 2018. You know, we had the Volmageddon in 2018 when the inverse leverage vol funds blew up and the market was down 20% very quickly, but it recovered. Or is this the beginning of a long recession, right? Like we had in 2007. So I actually don't know the answer to that question, right? So today is Tuesday and it's turnaround Tuesday and stocks are up and everything is recovering. And this will probably continue for a little while. My guess is we're going to get round 2 at some point of risk off. I don't know what that's going to look like. I don't know when that's going to happen. But I think things are going to recover for the next week or two.
Let's move into the market headlines. First up, Dow tumbles 1,000 points and the S&P 500 posts its worst day since 2022 in global market sell-off. So for some context, the Dow dropped over 1,000 points or 2.6% on Monday. The Nasdaq fell 3.43% and the S&P 500 slid 3%. The Dow and S&P registered their biggest losses since September 2022. On top of that, crypto sank, the VIX skyrocketed, investors piled into Treasury bonds, and Japan's stock market posted its worst drop since Wall Street's Black Monday in 1987, contributing to fears of global turmoil in the markets. Do you think this marks the final stages of a sell-off that began last week, or is this more so a signal of the beginning stages of a larger crash?
The VIX is something we should talk about. The VIX yesterday got up to like 64, 65, something like that, which is the highest since the pandemic crash, which was the highest since the global financial crisis. It's pretty rare that the VIX gets above 40. Like even in the middle of the .com crash, the VIX only got to 40. In the bear market of 2022, it never got to 40. So this is very unusual. And the thing that's weird about it is, like, nobody can really pinpoint why it happened. I mean, there's a whole confluence of factors, right? So the Fed didn't cut when they should have. Then we got a weak payroll report. We had people who are overextended in tech and AI. You had the yen carry trade unwind. It was just kind of the perfect storm of whatever, and like it resulted in one of the biggest volatility dislocations I've ever seen. Now the cool thing is that in the weeks leading up to this, in the Daily Dirt app, I was telling people that they should be buying S&P puts. I said you cannot buy enough volatility, and it absolutely worked.
So you've got some short positions in Street Freak. And by the way, for those who missed last week's episode, we teased a new trade idea that Jared is working on. I'm not going to spoil it or anything, but I will say that it's a big short 2.0 kind of trade. So go check that episode out for more info and visit jaredsurvey.com to help us move the idea forward. Anyway, though, Jared, my question for you is, how imperative is it to have some shorts in a stock-based portfolio, especially when you get something like yesterday's shitstorm where fear and uncertainty pretty much just moonshot?
I actually don't know off the top of my head how the Street Freak portfolio performed yesterday. I mean, we're about 40% short in that portfolio. So naturally, you know, if you have some, look, I don't recommend this for everybody. Like, short selling is very dangerous. It's very complex. It's not suitable for everybody. But if you are a sophisticated investor, one way I like to do this is to basically run a 130-30 portfolio. So it's slightly leveraged. You have 130% longs and 30% shorts, or a 130 portfolio, which is basically what we're doing. So I don't like market neutral portfolios because then the market generally goes up most of the time and you miss out on the benefit of that, and your shorts end up just losing money all the time. But if you have a slight tilt to the short side, it smooths out the volatility of your returns. That's one of the reasons why we do that with Street Freak. So
for the next headline, we've got traders rush to hedge against extreme market events after Manic Monday. There's that phrase I was talking about. I want to focus on the VIX a little here. Three things I kind of want to address. First, are we already in a recession? And if not, is one imminent?
You've probably seen something in the news about the SOM rule, which is named after the economist Claudia Sahm, who used to work at the Fed. And she works at New Century Advisors right now. And she has basically said, well, the SOM rule says that, I think what it says is that when the 3-month moving average of the unemployment rate gets 0.5% off the lows, then you are already in a recession. Okay. So that happened with the payroll report that we just had. Like that, the SOM rule basically says that we moved into a recession. So I don't know if that's true. The unemployment rate got down to 3.5%. Now it's at 4.3%. So we'll see.
So my second follow-up question is, how can traders insure their portfolios against an extreme market crash? I'm guessing maybe don't, YOLO your grandma's inheritance in Bitcoin or AI stocks, but what's your thoughts on that, on insuring your portfolio?
Insuring your portfolio is, you have to have an understanding of options. You have to know how options work. 99% of people don't know how options work. 92% of people don't know how short selling works. So for the vast majority of people, like they're just going to have an unhedged portfolio and there's nothing they can do about it. Like I had a hedge going into yesterday. I had a bunch of long dated S&P puts, about 80% strike, and the hedge performed pretty well. I want to say I made 1 or 2% on the value of my holdings. So I was probably about flat yesterday, which is how the hedge is supposed to work.
And third, do you think the Fed will expedite things with an intermeeting rate cut? And if they do, what are the implications of that? Does that signal panic to you?
I think that the Fed should have cut rates on July 31st. And I think that now they realize it's August 6th. They realize they should have done that. Okay. So it would cost them very little to do an emergency intermediate rate cut. It's basically an acknowledgement that says that they were wrong in the last Fed meeting and they're going to cut. But it's also, it can be interpreted, like you said, as panic. It can be interpreted as panic by the Federal Reserve. So I think they're going to try to hold out until the September meeting. But the problem is that there's a better than 50% chance that we're going to have another risk off event between now and then. It could be more severe and it could force their hand and force them to do it. So yesterday morning, I thought there was a 90% chance they were going to do an intermeeting rate cut. Anytime the VIX gets to 60, the Fed is cutting rates. But by the end of the day, volatility had subsided. Markets are up today. Things are getting back to normal. So I think the probability of that has gone down.
All right, let's take it over to the main topic. I want to talk mortgage rates and housing. I know we've talked about housing in the past, but that episode didn't air due to some audio technical difficulties that we won't get into. I saw that you tweeted, easily the dumbest and most frustrating question I get from non-finance people. The Fed didn't cut rates, so why are mortgage rates going down? I will be the first to admit I'm not a finance guy. My talents or lack thereof lie elsewhere. But I saw this headline on Bankrate that says mortgage rates fall to year's lowest levels as investors buy Treasury bonds. And basically, the gist of the article is the rate on 30-year fixed rate conventional mortgage directly correlates with the yield on 10-year Treasury. So when the Treasury yield falls, so do mortgage rates. As of August 5th, we're recording this on Tuesday, August 6th, by the way. the average rate on the 30-year fixed rate mortgage was 6.75%, and the yield on the 10-year Treasury dropped below 3.7%, the lowest it's been since May 2023. So questions 1 and 2 here. What's the correlation between higher unemployment rates and lower mortgage rates? And do you see these factors giving borrowers a window of opportunity for purchasing homes?
Yeah, I do think it's a window of opportunity for buying a house. The last I saw, mortgage rates had got down to 6.3 something. As of yesterday, mortgage rates were down to like 6.3. They could maybe get down to 6 in the near term. But if you bought a house and got a 7.25% mortgage, and if mortgage rates are now 6.25, you should refinance. You should absolutely refinance. And if rates go down another percent, you should refinance again. You should absolutely take this time to refinance. I was talking to a real estate appraiser the other day. As you know, when you refinance your mortgage, you have to get an appraisal. So her incoming calls are picking up. People are doing refinancings. So, but I do want to get back to the original question, that thing that I tweeted. So, what a lot of people don't understand about interest rates is that when you talk about interest rates, you have to specify what interest rate you're talking about. And you have interest rates across different maturities. So you have overnight interest rates, you have 1 month interest rates, 3 months, 6 month, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, and 30 year. So you have all different kinds of interest rates. And they're somewhat correlated, but not always. So right now, the Fed funds rate, which is the overnight interest rate, is 5.5%. But as you said, the 10 year is 3.7. Okay. And what the bond market is essentially doing is pricing in future Fed rate cuts. Okay. So, but long maturities can do something completely different from short maturities, right? They don't have to move in the same direction. That's basically what I'm saying.
I kind of asked this for selfish reasons, but what do you recommend for younger generations looking to buy their first home? What steps do they need to take to put themselves in a secure position?
Well, you got to save up for the down payment for sure. And that's the toughest part of buying a house right now because, 20 years ago, before the financial crisis, banks were lending, they were doing 100% financing, 90% financing. People didn't have to put down payments. You pretty much need to put down 20% right now. If the average house is $400,000, that means you have to put down $80,000. That's a lot, right? So I would say the number one thing is saving up for the down payment. But also, you have to save above and beyond the down payment, because if you just save $80,000 and put it in the house and you don't have any savings left over, that's a very risky thing to do. So you have to have savings above and beyond what you have for the down payment.
Let's take it over to the week ahead. Anything you're anticipating here coming up?
I'm just trying to stay alive here. It's a very difficult trading environment. It's like I said, I think that the risk is subsiding. I think stocks are going to rally over the next week or two. And it really gets to that question of, was this just some sort of market dislocation that lasts for a day and then everything gets back to normal? Or is this the beginning of a long-term trend? And I don't have the answer to that question, right? So,
are you still planning to hit Chicago this week? Or is the hurricane throwing a wrench into that?
Yeah, I literally just canceled my trip an hour ago. If the plane took off and I got there, that's one thing. But I think it's kind of irresponsible for me to leave a new house, which hasn't been in a hurricane before. I kind of want to be here in case something goes wrong. So I think it's just irresponsible to leave. So I think it's a smart move just to stay home.
Yeah, for sure. Let's wrap this thing up. Jared, thank you for your time. Everyone, make sure to like, subscribe, leave comments. Jared, we'll be back next week, and I will talk to you soon.
All right. See ya.